And I have them on this slideshow, so we'll tackle each one.
Okay, great.
All right, everybody, welcome back. 2022, we are Affordable Homeownership Roundtable. We're back in session. And yeah, there's a lot of changes, but there are also a lot of things that continue to be challenges. And what we're going to talk about today is three of the top issues that we've kind of identified between America's Homeownership Alliance and the Affordable Homeownership Roundtable. We're trying to build awareness, and we're trying to create a collective voice to push back and influence policy around some of these topics, because they're complex and they feel like sometimes they're immovable mountains. But the reality is if we build enough awareness and we start having this conversation, we can take this conversation to policymakers and try to start influence this. Kind of what I wrote in the description for the show today is, a lot of these policymakers, you guys up in Washington, they're pretty far removed from being on the streets, right? They don't necessarily, they don't understand what it's like to be a loan originator. They don't understand what it's like to be a realtor. They don't understand what it's like to be a first-time home buyer. And they're making a lot of these decisions, and the people that are giving them information are a lot of big interest groups that are trying to influence them to make decisions one way or another that's going to benefit what they perceive to be the most important people. And the reason we're all here today, and present company not included, you guys are some very important. I mean, you guys are important players in a part of this industry that most consumers don't see or get access to. So, we let's I think that's the setup. Let's go right into loan level price adjustments. Tino, I saw you shared something. They're jacking up the costs again, aren't they? Oh, I don't have sound.
Audio.
We don't hear you.
Can you hear me?
Yep.
There we go. I'm sorry. Yes, of course. And I don't know about being a Grost member of this thing, but I sure make a hell of a lot of noise.
But that's all we need.
So the yes, the loan level price adjusters basically when for you to get a loan that's more than 80% of the value of your property, you have to get private insurance, which basically insures the balance of that loan that's above the 80%. So the lender will want to make the loan to you, and more importantly, so that the loan is sellable in the resale market, what we call a secondary market. Okay.
And so Tino, it's important to note the insurance benefits the lender.
Yes, that is correct.
And the buyer downstream of that loan.
How I've always explained it to consumers is it's an insurance policy that the lender takes out that you pay the premium for, that protects the lender in case you stop making your payments.
Yeah,
that's correct. Otherwise, you would not get the loan extended to you.
Yeah.
And it would not be, in a sense, a marketable security in the secondary market, which is what is used to bring money back to the lending. Because once you lend out the money, if you don't have more deposits coming in or loans are not repaid, you basically run out of money to lend. So when you sell it into the secondary market, you recuperate that capital and you're able to lend again. And that's what's important about that. So what about loan level price adjusters? So what happens is the private insurance companies decide what the risk is of a person defaulting, and then they put a premium on that. It's like the insurance premium, right? And it's paid on a monthly basis. Well, guess what? That risk is already then covered by that primary insurance, whether it's called, guaranteed or whatever the name of the company is. They've already covered that risk. It's done. It's already taken care of.
Consumers know it as PMI, right? PMI, private mortgage insurance. Yeah.
Private mortgage insurance. And so now you go and you go to try to sell this to a buyer, which the majority of the buyers are agencies, basically the what we call the GSEs, which is government sponsored entities, and that's Fannie Mae and Freddie Mac.
Yep.
They are regulated. They're watched over by the Federal Housing, the FHFA, the Federal Housing Finance Authority. They have agreed that it's okay for them to charge an additional premium over and above what's already being charged by the PMI to take those loans in. And they're doing it not because there's more risk that is being covered. They're doing it because they can. It's that simple.
Yeah.
They can do it. And so therefore, the consumer is basically being double charged. The first time so that they can get the insurance on the excess over and above the 80%, so the lender will extend the loan to them. And so that's being taken care of. But the second piece, which has no additional risk, because that's already taken care of by the loan amount on the property that you have and the insurance that's already on there, they're tacking that on. So it's basically a double whammy that's being put on the consumer just because they can. It's an additional charge that doesn't cover an additional risk, but it is an additional charge where they can make more money. And so, given that the GSEs, they were formed to sponsor home ownership, to make sure that home ownership prevailed and grew in America, this act of double charging on the insurance is basically cutting back the opportunity for many people to buy a home. They're charging these things on, hey, how you doing, Phil? They're charging this double whammy on folks that are either buying it for a second home or folks that are trying to take out an additional, taking out cash out refinances and those kinds of things in their home. That's already theirs. It's already their home, but it's being charged twice. And that's why we find it very offensive there's no additional risk, but yet it curtails, it's lining the pockets of the government-sponsored entities, Freddie Mac and Fannie Mae, with no additional risk, but it is curtailing the issue of home ownership for Americans. And that's the big problem that we've got with that.
Well, so let me unpack this a little bit. You used a couple of acronyms in there
Yes.
too, and I kind of want to see if we can bring this down to the consumer, something that they'll understand a little bit better. So, and I Phil, correct me if I'm wrong here, but we're talking about Fannie Mae and Freddie Mac, so we're talking conventional financing, FHA financing, VA financing, USDA. They don't have these loan level price adjustments because they have the mortgage insurance that's provided, the mortgage insurance or guarantee vehicle provided by the government. So it's the VA guarantee fee or mortgage insurance premium offered by FHA. So am I correct, Phil, that Fannie Mae and Freddie Mac basically wrote the rules for private mortgage insurance in order to protect lenders against default? And then what Fannie and Freddie are doing, and like you mentioned, Tino, these entities, government-sponsored entities that were previously just overseen by the government, but now they're in conservatorship, right? Right. They are designed to promote home ownership, and yet who they are penalizing is anybody with less than 20% down payment and less than an absolutely perfect credit score. That's where the loan level price adjustments are coming in. So That's right. Driving up the interest rates and it's driving up the closing costs for anybody that can't come up with 20% down or they have a 680 credit score. You think that doesn't sound bad, but I think the loan level price adjustments stop at like 620, 640, somewhere around there. Is that right?
Well, the problem is not so much where it stops, but the issue is that you're hurting the majority of folks who are trying to come into home ownership from the very beginning. This hurts the folks that are scratching by, the hardworking families that are trying to get into their first home, they're trying to buy their first place, and then you're adding on this additional burden, which basically either takes them out completely out of home ownership, or it's an additional burden on a family that is not merited because the risk is not there. It's just being charged because they're making more money, period.
Because they can. And just recently, they're increasing those rates. If a family wants to buy an investment property right? Or maybe they moved out of their primary residence into a new home and now they want to refinance that home that they've been renting out to create cash flow for their family. That price just went up. And anything that's considered high balance. So anything in the coast, anybody in California, anybody who's above the conforming loan limit, that just got increased as well. So not only is it egregious that it exists at all, but they're continuing to increase those costs really because they think they can get away with it, because they think people that live in high cost counties and investors are, let's call them rich. And so let's see what we can get from them. And I know this is on the top of our docket for what America's Homeowner Alliance is really pushing towards. And we're really trying to push back against this and trying to get the policymakers to start having a conversation about loan level price adjustments and the double taxation that they're putting on consumers. So, all right, we got two other topics here, and Phil, you can go ahead and jump in whenever you want. This one we had a really good conversation about on the America Homeowner Alliance call last couple of weeks. And we're talking about leveling the playing field against investors. And when we say investors, there are these institutional investors, we'll call them, or hedge funds that are collecting money from people that have money, and they're just going out and they're buying all the single family residences, not to resell to first-time homeowners, but to any homeowners, but to hold and turn into rentals. And I don't know if we have time to unpack how many problems that causes, but it's a challenge. And so one of the things that we're really trying to figure out, that we're actively having conversations about, is what does it look like to give the single family trying to get into their first home or just trying to house their family, to give them just the same chance that an investor has. But I mean, what's the biggest problem with this? What's the biggest problem that consumers are running up against when they run up against these investors?
It's a transfer of wealth. It is, you are taking the ability of the American family to buy their first home and begin to accumulate wealth for themselves and for their heirs, and putting that into the hands of Wall Street. And they have an unfair advantage at Wall Street because they have the cash in hand to come in and buy those properties. But mom and pop home buyer don't have the cash. So when a corporation swoops in and says, I'll pay you cash for that property, many folks are willing to turn to that because they know it doesn't have any issues with appraisal. It doesn't have any issues with the condition of the property or whatever. They're just being bought, period, cash. And that takes the families out. We have a huge transfer of wealth taking place, and we are impoverishing the nation. We are basically causing the middle class to shrink, particularly the young folks that are coming in the 20 to 30 years old. That's the next batch of folks that are coming in to try to build the wealth of America and build the middle class. And what this does, it works directly against that. It destroys the wealth of the family, and it transfers it to the investor, which is picking up that property, renting it out. And on top of that, some of the practices are really egregious because the cost of maintaining the property, the cost of upgrading things and all that is passed on to the renter. So rather than the renter buying their home and improving it and putting those expenses back into their own home, they're paying for someone else to do that while the property appreciates in value and they are impoverished. Second, they're also being charged they would be paying a higher rate of rental than they would if they would have bought the home. In other words, the home purchase would have allowed them to pay a steady, lower payment on a monthly basis going forward, which is another way of accumulating wealth, right? Lower cost. But this way, they have to pay a higher cost, and it's going to rent. So that's the really big issue. It's the transfer of wealth is a major, major issue.
And these investors are paying they're paying more than the properties are worth.
Right.
Correct? In a lot of cases. So it's not even a matter of the seller taking a little bit less money for all cash. They're getting what they're asking for and more in some cases, because these hedge funds are working off of spreadsheets and they're doing rental revenue projections.
Right.
They don't care what the property is worth.
Exactly.
Yeah.
Their guidance to determining how to buy that property is based on the income stream they're expecting from that. But lenders are required to qualify the buyer based on the income that the buyer makes and the debts that are outstanding on that buyer. The renter doesn't have to go through that kind of scrutiny. As long as they've got a halfway decent credit score and they have 3 months for deposit, they get into the home, and now they pay more for that home on rental than they would have paid on a monthly basis had they bought it with a mortgage.
Scott, let me just add a couple of pieces of color. I think you guys have described it correctly, but I want to just maybe add a little bit more of the emotional aspect of this from aspiring homeowners. So when you think of people that have formed a family or a household that want to buy a home as the major step in their future, in their life, and this doesn't matter if it's single individuals or, husband and wife or life partners, doesn't matter. When you think about those people working really hard to save money and to get their credit score in order and save a little bit of reserve for the unexpected events in life, and they work for 2, 3, 4, 5 years to get to this point, and they work their rear ends off to sustain their employment, and they finally get to a point where they find a home that they want to make an offer on as their next big thing in their life. They make a bid on a piece of property, and that bid is laying on the table next to 5 cash offers. So these people that are the aspiring owner occupants, in 99% of the cases, they need financing. And it may take 30 days or 45 days or 60 days to get their financing approved to remove all the contingency issues. When a person makes an investor makes a cash offer for a property, a seller and the real estate agent representing the seller has a fiduciary responsibility. They have to represent the seller to provide whatever the best transaction is for that seller. And in most cases, almost all cases, when people are offering full price cash or maybe even above the listing price for cash,
no inspections, no appraisals,
no inspection, no appraisal, no contingencies, no repairing the site or the porch, no repairing the gutters, no this, no that. And an owner occupant has an offer on the table that's going to take them 45 days to get approved and may require appraisal issues and repair issues. And it's just it is so emotionally draining for the aspiring homeowner to perpetually make this overture to find a home, to buy it in a neighborhood they like, and then to be, time after time after time, be beaten away by the institutional investor. When Tino talks about the transfer of wealth, that's what we mean when we say the transfer of wealth from Main Street to Wall Street. It's the individual consumer, aspiring homeowner, simply not having a hope to be able to compete against these investors. And, we all live in the free market America, and none of us want to impinge opportunity for investors and free market activity and wealthy people and other people to buy property if they wish to buy property. Our point is we need steps to level the playing field so that the aspiring owner occupant can be viewed simply in the same context as a cash equivalent buyer. And there are things we could do to level that playing field, but we can't do it without the action of the consumers of America enrolling in the America's Homeowner Alliance so that we can have the voice of the people and we can make policy changes to make consumers cash equivalent buyers. And that is the long-term solution. But it is a chronic issue. If you saw the Redfin real estate report recently that in some cities of America, more than 30% of the properties are purchased by these investors, and that just takes those out of the marketplace for opportunity for aspiring homeowners. And it clearly will, because we are in this situation with an overzealous amount of demand for single family home ownership in America, meeting the lowest supply of single family homes in the last 30 years. We're in a situation where that supply demand imbalance raises the appreciation value on real estate almost in an unprecedented fashion. And that's why these investors are after these homes. They like the cash flow return from the rents, and they like the property value appreciation that gives them ample return on their investment. And we've got to find a solution for this.
Yeah. So make no mistake, the Godfather Phil has people he can talk to about this. But when he has 1 million people, consumers behind him that say all of these people are aware of this problem, and if you want to get reelected, Mr. Senator, Mr. Politician, we want your ear and we want you to really hear these things. So our next topic is inventory shortages. But before we dive into that, because it kind of feeds into this, but the other thing that I wanted to kind of mention, and I've seen this several times in my career as a loan originator, the unintended consequences of something like this is, yes, they're temporarily putting they're hurting inventory. They're taking inventory off, so they're driving up home values. But what they're also doing is they're taking stabilized neighborhoods and they're increasing the percentage of rental properties in those neighborhoods. And it is a very, very well documented byproduct that the more renters you move into a neighborhood, you don't have the pride of ownership, you don't have the upkeep on the maintenance on the properties, you don't have improvements on the properties, and at some point it starts to put downward pressure on home values. And it's kind of hard to measure when there's no homes available, because so demand and lack of inventory is driving up home prices. But at some point, the chickens are going to come home to roost. And when 30 to 40% of your local neighborhood are renters, because investors went in and bought all of the properties from people moving out, at some point that's going to have an impact on property values in that community.
And on safety.
And safety. Yeah. Yeah, because you don't always know who your neighbor is. Maybe you got a new neighbor every once in a while. Maybe they're doing short-term rentals, Airbnbs, and you've got all kinds of people coming through.
We are social animals. We're tribal animals. We have an incredible thousands of years of history of doing that. We establish trust by interacting with one another. When you have people who are transient, you don't have the ability to establish that trust, that interaction, and get to know your folks and be able to, in a sense, protect yourself and them. And that's a major issue. And people don't look at it that way. But one of the reasons people buy a home and they look at the neighborhoods they move into is safety.
Yeah.
Scott, let me mention just one practical practical issue here. That's we don't talk about this much, but it's real. I want you to just focus, and the listeners to focus on all of the condominiums in America. And when you think about investors buying up all these condominiums, in most of the condominium projects in the United States, there are what unfortunately are called owner-occupant requirements and pre-sale requirements. Mm-hmm. And in many condo projects, an owner occupant can't get financing in that project if more than 50% of the owners in the project are renters.
That's right.
The whole
Isn't that
project
interesting?
becomes inaccessible by the owner occupant if investors buy up enough of these properties and rent them out. Eventually, and those are, generally speaking, those are very attractive type entry-level units for first-time home buyers and emerging market consumers that, so I just, when you think about the practical application of this, there is an impingement of opportunity that's growing like crazy because of these investors buying these units that make it such that owner occupants can't buy them. And that's only one. Some of you may have seen the National Association of Realtors report that there are actually fewer single-family homes available for sale in America than there are realtors to sell them. That's the first time in history. In fact, it's not even close. Almost 1.2 million real estate agents and 679,000 single-family available homes for sale. We've never had an inventory shortfall like this. And when you see a shortfall like that, where demand is just so extraordinary, as long as interest rates are at these levels, everyone that can possibly become a homeowner is aspiring to be a homeowner. This may be the only time in their life they can get a 3.5% mortgage. For those of us old enough to remember 17% mortgages, go get the 3.5. But the point is, the demand is just out. It's just crazy, and it should be. It should be. The problem is there isn't enough inventory, and there are so many policy impingements that are just impinging the opportunity for builders to build homes and sellers to sell their homes, that we just have all kinds of things that could be solved by just policy changes that would change this dynamic by leaps and bounds. And it also comes when Courtney has more experience about this than any of us in dealing with people that want to sell their homes that are in a bit of distress, in a loan distress situation. And the point I made before about condominiums, if you can't sell your condo because renters are living in 75% of the condos in your complex, it matters to you as an owner occupant. I tell you, these are emotionally crisis issues for consumers in America, and we need help to solve these problems.
Yes, and I would like to reinforce what Phil said. This inventory shortage is at the doorstep of the policymakers. This shortage is a result of the policies that they passed, not because of the market doesn't work. It's because they have kept the market from working because of the policies that they passed in reaction to what things that happened before, and a reaction that was overdone, overkill, without any thought of what the effect would be on the consumer. So we are facing this dire shortage of homes because of poor policy decisions, which need to be reversed.
Can't put Band-Aids on bullet holes, can you?
No, you can't.
Well, you can. No, I mean, the thing that I was just going to add, because I mean, obviously you're listening to the best of the best, from a perspective here, is that from a really basic perspective, we're just talking about equal access to a thing that is so core to, kind of the foundation of, what this country is and what this country is about. And if none of this made sense to you, the way to look at it is that there's a whole bunch of people that get a whole lot more monopoly money than other people. And so they are able to buy Boardwalk, right, at the end of Monopoly, where, the average American consumer, who, by the way, is the majority of the American consumers, most American consumers cannot pay cash for a home, don't have access to buy Boardwalk on the Monopoly board. And that's why groups like this are so good to be a part of, because your support lets these fine gentlemen really shake some tables on behalf of these issues.
Yeah, absolutely. Now, real quick, we're at the bottom of the hour, so we'll wrap this up. A big part of the inventory shortage is new construction. And I believe the numbers just came out. We did an earlier episode when we first started the Affordable Homeownership Roundtable, and we talked about the cost of construction. It was somewhere around $80,000, up from $60,000 just to break ground on a new unit. The new numbers have been released, and it's now over $90,000. And does that sound accurate?
Yeah, it's actually
94.
Actually, $94,000 of regulatory and compliance costs before the builder puts the shovel in the ground.
See, that's crazy. That is just crazy. That policy can tackle that.
Yes.
Right.
Yes.
Right. That policy can make a dent in that. I mean, we're not asking for much, guys. We're just shave off 40 grand, in regulatory costs and fees. I'm sure we could get together and figure out a way to do that. It's not that hard. But it is that hard when we're not working together, and there really is no mechanism to have this conversation with policymakers except through groups like America's Homeowner Alliance and organizations that have a long history in the housing industry and know who to talk to and how to talk to them. So that brings me to kind of my final point. Help us stop bad policy in its tracks. Join America's Homeowner Alliance. It's completely free. We have a new petition page on the website. Please add your name to that. The more names we can get on there, the more leverage we have when Phil goes knocking on congressmen's doors. We want him to have a big stack of signatures under his arm to say, we're serious this time. You can't just kick me out like you did last time. So that's what we're going for here. If you're listening to this, and listen, if you're in the mortgage industry, people, my friends that are loan originators or real estate agents, this is impacting our ability to do our job and for our ability to help families. It's important that you learn these things and understand these things and do what you can on the ground level to educate home sellers about who to sell their home for. And like Phil mentioned a couple of times, there is an emotional aspect to this. There is, do you want to sell to a veteran? I know they're not giving you a down payment. Do you want to give the first home to this new family, even though you've got an investor coming in trying to pay you all cash, and it seems like it would be an easier deal? What is that going to do to your neighbors that you're leaving behind if you care about your neighbors? So these things are very important. Anybody have any last words?
Join.
Yes.
Join.
Yes. And thank you, Scott and Courtney and Tino and Brian for illuminating these issues. We're, everything is not pretty right now. We need action steps, but look, these are things that can be corrected. This is not, it's not hopeless. And we're
not raising money. It doesn't cost money to do this. These are just conversations that need to be had with the right people.
Right. It just requires influence.
Yeah. All right, guys. Well, everybody watching, you can join us here every other week. We're going to tackle a new topic, and we're going to incessantly push and ask you to join myaha.com/join. So help us save our breaths. Just go over there and join, and then keep paying attention and keep talking about the things that we're talking about. And together we can make changes and we can make a difference. So happy New Year, everybody. Thanks for joining, and we will see you next time.
Happy New Year.
Happy New Year.